I appreciate that, Trey. And I just really want to reiterate to everyone, if you enjoy this content, if you enjoy these webinars, please come back for our Q&A session that we have tomorrow. I know Jacob's one of the hosts for that, so we'll be able to take a deeper dive into questions you might have that maybe we don't have the ability to answer during the session today. So today, of course, we're going to start with defining what is fundamental analysis. Fundamental analysis is, of course, one of the basic ways you can analyze a company. Many traders will utilize that. Other traders might utilize technical analysis as a way to help them make their investment decisions. Um, we'll also take a look at a lot of the resources that Fidelity has online, and it really struck me how much Fidelity offers for free to our clients. I remember speaking with a portfolio manager, and she mentioned that what we provide for free to our clients is institutional quality information. It's as good as the information that she gets. So it's really, really good information we have online, and we'll dovetail a lot of what we talk about today with what you can find online with the tools and everything that we have and that we show. But again, please take a look at the other content that's available. There's a lot of really, really good content if you enjoy learning by watching videos, watching webinars, watching sessions and such as well. There's a lot of really good information out there. That said, we do want to go ahead and dive into defining fundamental analysis, but keep in mind, of course, that I spent a lot of time studying fundamental analysis. I do have a CFA designation. I am a chartered financial analyst. It took me 2.5 years to achieve that. I know Jacob has a master's in finance. It took him a long, long time for that. You're not going to get everything that you need to know in finance in an hour. So this is a little bit of a primer to kind of get you started in the process of actually diving into companies. That said, Jacob, why don't you kind of share with us some of those fundamentals about fundamental analysis?
Yeah, I'm really excited, Nick. Thanks, Trey, for having us. Folks, you are going to walk out of today with your feet wet and pointed in the right direction, knowing what fundamental analysis is all about and how you can get started. And let's start with just that basic definition. So, fundamental analysis is the act of trying to use any information available to decide how much the company should be worth. What's the right price for this company? How do we determine that? Well, we're going to use, like I said, any available information. That might include things like who is in charge of this company? Who owns it? Who's the manager? Who's the CEO? Are they high quality individuals? Are they visionary? Do they know how to lead people? That quality of management is important. Labor relations, inventory controls. We've got a whole list on here, and many, many more would be considered as well. But the key when we are thinking about and determining our position in the fundamental analyst role is to figure out what the right price is for the company. Much of that is going to be based on an understanding of the current economic environment for that company. Are a lot of people buying that type of product currently? Is the company able to charge such a price that they are able to generate profits after paying all of their ongoing expenses? These are the questions that an analyst is thinking about, both relative to the past, have they done this successfully? But also, what does the future look like? Does the horizon appear to be beneficial and even advantageous for a company in this business? Is it likely that your company is going to be able to generate extra profits, grow their business, given the current environment? Knowing that that's the case, a fundamental analyst uses all available information to make their final determination and label a target for their price. However, we recognize there are some limitations in fundamental analysis. One of them is that it doesn't necessarily tell us when we should take action. Suppose that your analysis supposes and purports that a company is a good company, a company worth investing in. Well, when do you start that investment? And when, in turn, do you take those profits and move on to another? The timing isn't immediately answered, although it certainly is something you will have to wage war with and decide with yourself when you are going to go ahead and make that timing. Making your selling decision. When are you going to end that trade? Clearly, this is not fundamental analysis's forte. Finally, the quantification of risk versus reward can be difficult, as you are supposing that the company should be worth something other than what it is worth right now. So you would need to have some sort of a plan in terms of how willing you are to allow the market to prove you wrong before you are admitting that you're wrong. What if it goes the wrong way? What if it goes down after you buy the security? If you do, you would start to lose. But as a fundamental analyst, viewing the price going down is like seeing the prices on your favorite goods at the store go down. They're on sale, they're a better and better deal, as long as your fundamental analysis of the company remains true. So that's our starting point in what fundamental analysis is. But we're going to talk a lot about this as we work through the information. And Nick, I think it's up to you to talk us through where we're going to look to find the information.
There's a lot of information that we have available to us as traders on Fidelity and other locations that Fidelity does provide, whether it's directly on Fidelity or whether it's links to the SEC's filing website for that particular information. There's a lot of really good information that we have, but it's also important to think about what kind of information is it that we're looking for. I know a great example with this is Jacob was doing a sectors class earlier today, talking about different strengths in different sectors, sector rotation. Many investors will take a look at business cycle analysis for a macroeconomic viewpoint of investing. And we'll take a look at that macroeconomic viewpoint to look at, well, do we want to invest in technology companies versus utility companies and so on. And so more goes into it than simply looking at a company's financial statements. Now, digging into balance sheets, income statements, cash flow statements, and such, looking at the building blocks of a company to implement all that information into a dividend discount model, a cash flow model, some sort of capex model. That's starting with the bottom up and looking at and going, well, the value of those future cash flows should be worth this. Because when you're buying a company, what are you buying? Well, you're buying a share, you're buying a slice of its future earnings potential. And that future revenue, those non-equal revenue streams, they're worth something. And you do, of course, also expect that revenue to grow. If that revenue isn't growing, if those cash flows are finite, well, that might be more like a bond, so to speak, that then pays the cash flows and then comes due. But if those cash flows are expected to kind of continue in perpetuity, that quote going concern of a company, if they're expected to continue but also expected to grow, well, how fast are they going to be growing? Well, this comes into play with macroeconomics. Looking at GDP. U.S. GDP was right about $28 trillion. Was just below it. Now it's right just above it, according to last quarter information. But when you get very, very large companies, how fast can they really grow? The answer is they start to become limited according to GDP growth. Now, you could have a $100 billion company, and it can grow times 10. Grow times 30, and be okay. And $100 billion is still considered a large cap company. You could have a $5 billion company, could become a 50, could become a 500, could become a $5 trillion company, 1,000% growth. That's possible over a shorter period of time. But is it possible for a $3 trillion company to become a $30 trillion company in just the space of a couple of years? Well, going from 3 trillion to 30 trillion would make it, right now larger than the entire US GDP. So it's a little bit less possible for something like that to happen than from a 5 billion to become a $50 billion company. And so that top-down approach is taking a look at GDP information, fiscal policy, what's going on with the Fed. The Fed happened last week. And then maybe looking at and saying, well, if GDP growth is 2.7%, well, I expect this company to grow at GDP plus a spread, plus 2%, plus 5%, which might make it more reasonable compared to 15% growth, 30% growth that, many technology, even many large technology companies might be expected to perform. And so it's, again, the difference between a bottom up, the top down approach, it's definitely something to be aware of on both sides because, what that environment is, what interest rate environment is can still even impact, assets, it can impact liabilities, it can impact other things on the balance sheet for a company. Now, that said, let's go ahead and dive into company-specific information, what a company reports on their financial statements. And let's start with the balance sheet. Jacob, why don't you kind of introduce to everyone that basic information that's on the balance sheet and what traders might be looking at?
Yeah, this is going to be our first stop, folks, in our journey as a financial analyst, fundamental analyst, trying to understand how much this company's worth. Well, the first thing we need to do is look at what they say they're worth. And that's the balance sheet. The balance sheet is going to give us the information of all the stuff that they have, all the people they owe money to, and therefore the resulting grand total. If this was our own personal finances, we might call this the net worth, our personal net worth. Go ahead and take a look over here, folks. And as we look, our balance sheet is going to include our assets, all the value of our stuff. That means anything we could sell potentially. Our inventory, certainly going to be included there. The value of our bank accounts. If the business has investments, they would all be included there. But likely it's going to include some form of real estate, maybe some property. There's going to be some equipment to manufacture if they're in the manufacturing. They're going to have all sorts of assets that exist. Some are even what are called intangible assets, things you can't necessarily touch, but that have some value, like the value of their brand or other acquired goods. Continuing on down the list, we see liabilities listed. Liabilities is all the stuff that we owe. This might be an outstanding bill to another company, something that they have performed a service for us, but we haven't yet paid them. That's a bill payable. Maybe we've got money that we borrowed from a bank or even from investors that's going to come due. All of that will show up under liabilities. Finally, after taking all the stuff we have, our assets, subtracting our liabilities, we're left with our shareholder equity, our resulting value there. Shareholder equity then is the idea of what's left. If we take all our stuff, pay off the people we owe, how much do the shareholders walk away with? Theoretically, a positive shareholder equity means that we have some value in this company. Now, there is a few things we need to be aware of, including that all of this is prepared by accountants with a very specific purpose. There is a few things that we need to know about them. So let me first show us how we can navigate to these types of reports on Fidelity.com. I'm already logged in and I have searched Microsoft. You can use the search bar up here in the top right-hand corner to choose the security of your choice. We'll use Microsoft as a demonstration today. We'll go ahead and scroll down just a ways, and we notice that there's several different headers. You will first land on Overview, but I brought us over to Statistics. When you click on Statistics, you'll be brought to a page just like this for the company that you have selected. And by default, we are looking at the balance sheet. If I scroll down, we indeed find a list of the assets of Microsoft. And at first, it looks a little bit, frankly, underwhelming. $80,000 is all the cash they have? Some of you in the audience might have $80,000 cash. Well, take a look up here in the scale here in the top right-hand corner. This is in millions of dollars. They have 80,000 million US dollars in cash ready to go. In other words, $80 billion. Now that's a sizable amount of cash sitting around in their bank accounts. Receivables is the stuff that is owed to them, but they haven't received yet. They will eventually receive them. Scrolling down a ways further, we find liabilities and shareholder equity. And even further down, we get that breakdown of liabilities as a total and shareholder equity as a total. All of this is available for you right here on fidelity.com. But our goal is to then make use of it. So, what would we learn from this balance sheet, assuming that we've made it available to ourselves? Well, one of the most important things we will do with a balance sheet is compare one line item to another. For example, what if we compared the current assets, that was one of the listed items under our assets, and compared it to our current liabilities? What if I needed to see how well I'm going to be able to pay the stuff I need to pay right away with the money that I have right away? The greater that value, it means the easier it is for me to pay off my current outstanding debts, and the healthier my company. However, if we find that the liabilities are larger than our assets, well, then that number will be less than one, and that does not imply strength for the company. In fact, it puts it in a little bit of a treacherous moment. If things don't line up just right, we may end up having to pay more money than we have, and that can be a concern. But all told, some of the value that we are going to receive from the balance sheet and the other financial statements we will be introducing you to now is understanding this relative value, one line item to another, and comparing over time, how have these changed? So we've got a lot to look at, but this was our brief introduction to the balance sheet. Next up is what's the company doing right now? Nick, you're going to introduce us to the idea of the income statement. Where is this money coming from that we're earning as a business?
Just like there's a lot of information on the balance sheet, there's a lot of information on the income statement. And so let me shift back over. I'm just going to pull up again Microsoft on Fidelity.com. And just to show everyone again how to get to where Jacob was, Stock Research Center, you have Microsoft pulled up. We're going to come over to statistics, zoom in just a touch, from statistics, financial statements, and this will default to the balance sheet. This time we're going to come to the income statement. So the top of line on the income statement is going to talk about sales. We'll talk about revenue, how a company generates money. And so this is also standardized on this by S&P Capital, where different companies might have different things. A great example of this is if we take a Dow component Walmart. Walmart will talk about sales, but they might or might not break it up. They do actually break it up into products and then service and other. But some of their competitors, some of the other big box stores will, for example, break out membership sales from other revenue and they'll break that up. And so different companies might have, different things that will go into sales turnover at different labels. Some will break it out more, some will break out less. But S&P Capital then standardizes all that information, all that revenue information is just sales turnover net. So this is in essence, again, what the company, brought in last quarter. Here we have that also in billions of dollars. So Microsoft brought in, 61,000 million or just under $62 billion in revenue. But what they sell doesn't come free. They have to pay for something. And so we have cost of goods sold, what it costs to sell their goods. And this can either be product, this can be other things associated with that. But it goes into that kind of subtracting from their income. So that sales minus cost of sales, we have their gross profit. And then from here, we'll have some selling, general, administrative expenses. So if this were a grocery store and somebody's buying a loaf of bread, they might sell a loaf of bread for $5, but they bought it from the bakery for $4. So it would be $5 minus 4, their gross profit being that $1. Now, they might then sell a bunch of bread. But then from here, now they got to pay their staff. They got to pay the cashier. They got to pay for electricity. They got to pay for all the other things associated with it. So now you start to get some of those general expenses that go into this. And again, this might differ from company to company, where one company might have research and development. One company might have other things, marketing and such with this. And so that's all combined. And then from the gross profit minus selling and general expenses, now we have our OI, our operating income. Then from here, if they're a manufacturer, is a great example of this. When you buy a machine, you expect the machine to last for 5 years. If it's a software company like Microsoft, maybe they've bought a bunch of computers. And they don't expect their developers to be able to crunch code on a 10-year-old computer. They have to replace these every now and then. Now, some companies, they might expense it all in 1 year. Other companies, for larger purchases, they'll take that expense over a couple of years. They'll depreciate that asset. That asset becomes worth less and less and less and less. Now, this gets into a little bit of accounting differences, with assets and such, that just because maybe an asset's been depreciated from what you purchased it at to zero, doesn't mean it's not worth anything. But that just then means its basis is that for an accounting perspective. And then, of course, if they sell it, well, there could be a capital gain, et cetera, on this. But that depreciation or amortization and such will be factored in here, then reduce operating income. Now you have your operating income after depreciation, amortization. So then we have our non-operating income, interest expenses and such, coming all the way down here as everything then kind of comes out until we finally get that net income. And so some of these fields might be labeled a little bit differently than you might be familiar with. There's terms like EBIT, earnings before interest and taxes, EBITDA, earnings before interest, taxes, depreciation, amortization. Here we, of course, have that depreciation and amortization, operating income, EBITDA on there. And then after we take that out, we'll then get some of those other factors. So these still are a little bit different depending on their use case, depending on their company. But again, a lot of this is standardized to make it easier to look at. Now, if a company is bringing in billions of dollars in profit, well, how does that then factor into what you might be concerned with you only own a couple shares? You don't own 20 million shares, and you're not going to get billions of dollars in revenue from that. You're only going to get that very specific slice based on how many shares you have. So that's where it then comes back to the earnings per share. How much is a company then making net per share? Because that's then going to apply for you being a shareholder. So with that, once we have earnings per share, that's where then analysts will start to do comparisons. What's the value of the company? What's it trading at relative to its earnings? And you can then compare similar companies with these particular metrics. With something like a PE ratio, analysts will use ratios to compare different companies. So you have two companies within the same industry, but one is trading at a higher price relative to its earnings compared to another. Does it make it more expensive or not? There's other things that might come into play here. But also keep in mind when you're comparing, let's say, a technology company to a utility company, well, technology companies tend to grow faster than utility companies. And so you might then have other ratios like price to earnings to growth, dividing the PE ratio by growth to then compare companies again. So it all comes back to these ratios, all come back to ways that you can compare one company to another and do it in an apples to apples metric. Because if we just look at it and go, this company made $60 billion and this company made $20 billion. Well, which is better? Well, obviously, a company that made more money would be better. But if you say this company made $60 billion, but spent 58 billion to do it, where this company made 30 billion and only spent 10, and they then have a better net, well, that completely puts a different spin on things with that. Now, I don't want to spend the entire time on the income statement, though. We could spend an hour on this. I do want to give Jacob an opportunity to kind of talk about cash flow. So once a company brings in money, what does that look like on their cash flow statement? Jacob, why don't you talk with us a little bit about the cash flow statement?
Well, Nick, for me, the cash flow statement is where we bring it back to reality. On the income statement, Nick, you introduced us to a whole bunch of terms that I would guess sounded completely foreign to many of you in the audience. They still sound foreign to me, and I've been studying them for years. EBITDA? What in the world are we talking? Amortization? Depreciation? What do these things really mean? Well, they're all an attempt by the accountants of the world to smooth out expenses so that we can understand ongoing expenses versus one-time expenses, helping us to say, all right, but how much does the company really make, right? Is this a reasonable number to make use of? If I was to buy that machine you talked about, Nick, once every 5 years, it wouldn't make sense for that to show up in one gigantic expense and then the next years to have no expense. I did have to pay for that machine. And so an accountant smooths that out over the 5 years of the expected life of the equipment so that we can understand better the ongoing costs of running the business. It's all done with the absolute best of intentions and gives us a lot of valuable information. However, it does leave an interesting question on our mind. But did they get any more money in their bank account? We don't know that from looking at the balance sheet or from their income statement. Those tell us, with all of the sleight of hand of the accountants, where the money ended up and what's happening for the business on a broad scale. The cash flow brings it back to you and me. But what about my bank account? Did I get paid? All right, here's what we've got. We've got receivables, payables, depreciation, and amortization. These were all things that showed up on the income statement that don't really exist. Receivables, I mentioned these previously. They show up in receivables, meaning the company is owed money, but we haven't gotten it yet. There's no cash in the bank account yet. Payables, it's money that I'm gonna have to pay. It's reasonable to include that as an accountant to say, I'm gonna have to include this. But money is still in my bank account. Depreciation and amortization are those smoothing out of costs and assets over time to make sure that we account for them in appropriate years based on their usage. But none of that is money. And so the cash flow statement is going to take us back and say, all right, let's actually look at the bank account. Is money flowing in? Is it flowing out? How are we doing? So let me go ahead and bring us back to Fidelity.com. We were looking at the income statement. Now we're going to swing over to the cash flow statement. When I click on it, we'll see that we start off with our final ending value, the net income that Nick told us all about on the income statement. That carries forward to right here. But then we're going to undo that wizardry of the accountant team and take out our depreciation and amortization. We're going to get rid of those account receivables. We're going to take out our inventory changes and accounts payable. Let's undo all of this and simply say, all right, our overall net cash flow, okay, all right, $81 billion, folks, was brought in to the Microsoft bank accounts over the course of that most recent quarter. That's some money coming in. And the question next becomes, well, where did that money come from? Because not all income sources are the same. Some of it might have come from, for example, investing activities. which means, are they going to be going out and selling new investments? Are they spending money on capital expenditures? What's happening in this area? Oh, yikes. It was not this area bringing in money. In fact, they spent $82 billion in ongoing expenses here, moving on through the list. Scrolling down and taking a look at financing activities. Is it that they sold a whole bunch of new shares of stock to bring in the money or raised funds in some other way? No, that wasn't that part. And then we get finally our change in cash and cash equivalents, working out all three of those into our final ending value. So, knowing that that's the case, working through these line by line, when we understand our cash flow and expenses, we've started to understand a little bit more about what the company is. Some of the key ratios that we would think about here on our cash flow is really about how much cash flow do they have coming in and dividing it out by share in the same way we use the earnings per share. There are many other analyses that we might do with this, but that's our starting point. I think, Nick, with this as our backdrop, now we can understand a little better the reasons and ways that an accountant might need to use some fancy methods in order to do this. But frankly, it would be unfair to us as investors if every accountant could do it whatever way they wanted. So we're going to need to understand the generally accepted principles that apply in the accounting world. And maybe you can walk us through some of that.
So much that we can dive into that. And, talking about those generally accepted accounting principles, GAAP, there are some differences out there in the way different accountants will do things differently. And, with this, that's kind of the discussion on how things are handled in the United States, according to GAAP, the generally accepted accounting principles, how things might be handled for an international company that follows the International Financial Reporting Standards, or IFRS. Things are a little bit different. What's required to be reported is a little bit different. Some other examples, some other differences is, of course, with GAAP and with the SEC, companies are required to report their information timely. They're required to report their financial information once per quarter. Internationally, this might be only twice a year. Some countries only require once a year, which is very, very different, when traders are expecting to see that information on that more timely basis. And so this becomes really important. Some of those differences between, the quarter reports, any reports, you have a lot more information to dig through for listed companies here in the United States. Now, some companies that are internationally based do also choose to be listed here in the United States, and then they do have to follow GAAP accounting standards. And many of those companies might actually keep two different sets of books, with those differences between it. And some of those differences come down to things like funded pension obligations. How are funded pension obligations handled? How is international revenue handled? A great example of this might be if a company is, based here in the US and they're making money in Europe. Do you look at what they paid at the beginning of the quarter, convert that to US dollars at the beginning of the quarter, and then convert end of quarter to US dollars, and then subtract the difference? Or you go euros start, euros end, difference, and then convert that to dollars? Well, this could have the impact that if the euro to dollar exchange rate changed significantly throughout the quarter, well, from one way of reporting to the other, the numbers could be quite different if you just converted to dollars at the end than if you were consistently converting to dollars throughout the period. And this again gets to that it's not to say one way is, incorrect. They're not cooking the books, so to speak, but GAAP then ensures that everything is done the same way, so that one company doesn't do it one way and one company does it a different way. And there might be times when one way might look better than others. And so this that ensures that there's not that difference in reporting. It's drawing investors' attention that actually is the company performance or what a company is exposed to that's drawing that particular attention. So with this, though, there might be other things in an earnings statement that might not fall under GAAP, and this might become lead to one-time write-offs, spin-offs, mergers, etc., divestitures and such, tax code getting changed. I know several years ago the corporate tax code was changed, and as such, large tax credits that companies had on their books all of a sudden became worth a lot less. If you were paying less in taxes, a lower percentage in taxes will carry forward losses, will reduce your tax burden less, and so that asset was worth less. So they took a lot of one-time write-offs and such. But we don't expect companies to have these write-offs consistently month after month after month. So therefore, we'll pull some of this information out of the reported earnings. So I pull back up Microsoft as an example. And so we do have, of course, GAAP earnings and adjusted actual earnings. Now with Microsoft over the trailing 12 months, the last 4 quarters, it's the same. And if we come down here to earnings detail, we actually have to scroll down quite a bit of ways until we see numbers that are different on here because it's consistently the same. And here we have 227 versus 271. We finally have a difference on here. With Microsoft, if you were to pull up information, like price to earnings information on Fidelity and other sources, because adjusted and GAAP are showing the same, you're going to get the similar PE ratio. But if we take a look at, let's say, Walmart, the other Dow component I mentioned earlier, we take a look at earnings information here, we see adjusted actual earnings per share here being 60 cents, where GAAP is 68 cents. So now if we're dividing price, $60 per share, divided by 60 cents earnings, we're going to get a roughly 100 to 1 PE ratio. Or if we divide it by 68 cents, we're going to get less than that because we're dividing it by a greater number. And so therefore, if you're looking at one place that's using GAAP for the E for price to earnings ratio versus adjusted, you might see some differences. And so it's important to understand what GAAP is, what's reported, and such with when you're looking at companies. Now, throughout the presentation, I know we've been going back and forth from the slides to actually showing Fidelity's tools and such. There's a lot of different tools that we offer to help you go through companies, to help you look at companies and such. Jacob, why don't you kind of walk us through some of those tools that investors can use to make the job of digging through a company's information easier?
I'll happily do so, Nick. Thanks very much. Folks, I'm going to start off as if you just logged into Fidelity.com. I logged in and here I am looking at the overview of my accounts, my portfolio summary. Well, there's a few ways that you could get here, but I'm going to use the search box up here in the top right-hand corner, and I'm going to type the ticker symbol I'm interested in. In this case, we'll continue on with Microsoft, for example. As we go ahead and hit enter or click on the link there, we're brought to this individual stock research page with all sorts of details available to us. We spent most of our time so far over here on this statistics sub-page. When I click on that, I'm presented with several different tiles with all sorts of details. I'm going to scroll back down to where we started to remind you how to navigate to it. We spent our time here under financial statements, and we had clicked on more so that we could see the balance sheet, the income statement, and cash flow statements in either quarterly or annual basis. Now, you have already learned quite a few things about this. There's much more to learn, but I would encourage you to keep these in your back pocket ready to review. But as Nick mentioned in the beginning, this 1 hour that you are spending with us isn't sufficient for you to necessarily pat yourself on the back and say, I am now an official financial analyst and I can go out there and do this on my own. So, knowing that that's the case, let me show you some of the resources that we can go ahead and move on and continue to apply. If I close out of this, but stay on the statistics page, for example, over here to the left, I find some details about those valuation metrics that we talked about previously. When I go ahead and click on it and hit more, I see some of the ratios that we already talked about. Nick spoke prolifically about our price to earnings. TTM here means trailing 12 months. Looking back 12 months, what has the price looked like compared to their most recent earnings? And over the last 5 years, what has that looked like? What about the growth of those earnings over time? And as I scroll down, you will see that there is many different metrics calculated for you and made available. The thing I love about this particular page is not only does it show us for Microsoft alone, but it also shows us compared to other stocks in its same industry. As a software company, Microsoft has earned a impressive 20% growth on its earnings per share. However, compared to other companies in software, it turns out it actually is relatively low compared to some of the earnings that have shown up here in the software industry. And if we line them up from highest to lowest, indeed, in this case, earnings per share growth right in the middle of the lane here for Microsoft, not standing out as the very best, near the very worst. There is one on this list down here at the bottom that shows free cash flow, a metric we would calculate from the cash flow statement. And at $70 billion of free cash flow, you can bet that it is the very largest free cash flow available in any company in the software industry. As we go ahead and scroll right back up here, folks, I'll take us to another page that I would encourage you to take a look at. That was our key statistics. Again, we got to it from statistics and then hit more on the key statistics tab. Next one I'm going to bring us over to is here on sentiment. The sentiment is the overall feeling towards that company based on what analysts are saying, what you in the audience are thinking and posting about. There's a lot to be said about analysis of the sentiment on a stock. Here we're going to find all sorts of varieties of sentiment available to us, including fundamental analysis, technical analysis, even environmental, social governance, and what are you and I posting about out there about this stock? So knowing that all of these are here, let's focus on fundamental analysis as the focus of today's discussion. We notice that, again, this comes from S&P Global Market Intelligence, phenomenal tool meant to help us simplify down all of that information on the balance sheet, on the income statement, cash flow statement, those ratios, and say, well, is it good or is it not? Let's take a look at the sentiment that we could derive from fundamental analysis. And we notice that in this case, instead of being compared against the software industry, we've zoomed out just a little to instead compare against the information technology sector. Here, S&P Global Market Intelligence has created for us 4 categories on which to judge these companies. We have their overall valuation, the quality, growth stability, and financial health. Each of them rated from 0 being bad to 100 being good. We would love it if our company was undervalued, because that means we're buying at a good deal. We're getting a bargain on what exists presently. Quality, growth stability, and financial health. The higher these numbers are, the greater the positive sentiment on the fundamental analysis sphere is. But some of these terms might be foreign to you. Or what do they really mean by quality? Quality of what? If we click on it, it will tell us a brief description about any one of these different attributes. Let me go ahead and click on the More attribute up here in the corner, and we'll zoom in and see all about this. How did we arrive at the valuation of 66, quality at 58? Well, these are the factors that S&P Global Market Intelligence compiled to make their determination. They made it very convenient for you and I, as perhaps novices to financial analysis, and put it on this scale of 0 to 100, with bigger always being better. But these are the actual ratios, where some we would like to be high and some we would like to be low. For example, do you want to burn all your cash quickly? I would guess the answer is no. And you don't want to burn all your cash quickly at your invested companies either. Lower would be a preferable metric here. So as we take a look, some are good to be high, some are good to be low. But if you're unsure about what some of them might mean, you can click on them for a brief definition related to it. For example, the inverse of the PE ratio adjusted for growth and yield, that's a lot of words here, but it's telling us, all right, it's looking at the trailing 4 quarters earnings. It's going to multiply them by the sum of the consensus for long-term estimates and dividend yields. So it's going to break down for us at least some of these ideas, working through them to help us measure how this change is occurring. By aggregating all of them together, here we've got this comparison between valuation, quality, even down here our growth stability, and financial health. Financial health is pretty easy for us to understand, for example. It comes back to those first ratios we talked about. How well can I pay for all the stuff I'm going to have to pay? Our current liabilities related to our cash or other varieties. So some of these are very accessible. Others you might need to do a little research on. But this is the stuff that's being relied upon in order to do so. If you would like additional information or a breakdown on how this really works and how to apply it in your case, I'd encourage you to use the link down here in the bottom left corner, which will pop up and give you an explanation on how you can apply this in real time in your accounts. So Nick, those are some of the many tools that are available here. And folks, we appreciate your rapt attention over the course of the last 50 minutes. But now we're going to go ahead and dedicate some time to you to answer the questions that have been sent in. Trey, any questions that are standing out from the audience?
Yeah, absolutely. Jake, Nick, do want to thank you as well for the great presentation here. We're going to jump into a few of the questions here. As a quick reminder to our audience here as well, the strategy desk and Jake himself will be presenting a 1-hour follow-up question and answer session tomorrow. So if we don't get to your question, if you're around tomorrow, check that out. Great session, just designed to answer any additional questions here. So let me start with this one here. This is a question that was asked in a few different ways here as we think about earnings season and some of those moves around stocks. But question here was from Brian. Many stocks recently seem to drop significantly after what looks like a strong earnings announcement based on the fundamentals. Brian gave an example of Kinsale Capital, symbol KNSL was a recent one. Can you just explain a little bit about why that might be, why we may have a good number, but then see the price drop afterwards?
There's a lot that goes into that. And one thing we talk about earnings season, especially in our aftermarket briefings, is we might see a company pop and pop a lot. And then we'll look at the company the next day, and the company not only went back to break even, but as much as it went up, it's now down. As instance May, it was a 10% up, and then it swung 20% down, and then it's 10% down the next day. That's because there's more that goes into it than just that top line information, than what a company made, what a company's revenue is, what a company's turnover is, and such. There's also that management's disclosure information there, which really makes up the lines portion of the statement. It's things like, we take Tesla as an example, a top 10 component of the NASDAQ index. Tesla had an earnings announcement, within the last 2 weeks, and they, in essence, said that, their revenue is disappointing and such, and things weren't as rosy. But then they popped based on other information. They popped based on, for example, recently, they talked about, partnering with another company in China for full self-driving. Other examples might be, a media company that has a great announcement, but then they say, well, subscriber growth is a lot lower than expected. Is that other information that might change things other than just revenue? AI investments and such has been a big topic lately. And maybe a company might be disappointing in revenue, but then they talk about that, well, we're disappointing because we've been dumping a bunch of money into property, plant, and equipment. And that's what's reduced our earnings. And we then expect these investments to pay off in the future. And we should then see increased revenue next year or next quarter at the expense of decreased revenue this quarter. And so some of those projections provided by management may push things one way or another. And I've seen a lot of companies that earnings and revenue they were great. They're much higher than expected, but maybe they took half of their revenue that's supposed to be next quarter, and they said, "Hey, we'll give you discounts if you go ahead and make the sales now." And so they brought it forward, but got less for it. And then if they're also expected to make less next quarter, that can impact things as well, or vice versa, where they again they took a little bit, they made a little bit less this quarter because they're investing for the future, expecting to grow a lot more. There's a lot to unpack there with that. Jacob, what are your thoughts on some of that as well?
Well, there was an interesting situation just in the last 24 hours where two specific companies released their earnings, both of them relatively positive enough that some analysts posted new updated opinions on the companies, increasing their price targets. In other words, saying, now that we know more, this company's worth even more. I understand it that much better. But both of those two companies that announced 24 hours ago are down substantially, one off over 5%, the other off over 10%. So why would good earnings, enough to increase on the fundamental basis, result in the price going down? Well, remember, there are two decoupled aspects. The fundamental aspect is, what should this company be worth? And then there is the current share price. The current share price, which is not what we've been talking about for the bulk of the discussion today, is based on what you and I do as buyers and sellers in the marketplace. The price of the security today is not based upon somebody's analysis and published report directly. It is directly based on the supply and demand forces in the free market economy, allowing that price to find equilibrium. The analyst report publishes their opinion on what the company should be worth. And if investors, you and I, agree with that report, the price would move in that direction. But it will move in opposite directions in some cases, all on the basis of the overwhelming supply or demand showing up to the market at the time of that report.
All right, great. Thank you both for weighing in on that one. I want to jump to another question here. Throughout the presentation, you talked a little bit about management and how that can fit into the fundamental style here as well. But a question we had from Terry was, how do you judge the quality of management? And Terry commenting that seems very subjective. So how does that actually quantify into your fundamental analysis?
Trey, I'm glad that subjective was the word that was used. It's absolutely true. It is. How good is that management? Some might say that the current CEO is the best CEO they've ever had, and others are lobbying for their immediate removal from leadership, right? So there is certainly some subjective nature to those. There also is subjective nature in all of the forecasting that applies in fundamental analysis. Remember, we're not just measuring what has happened already. That stuff is nearly factual. It's almost entirely numerically calculated by math. But the subjectivity comes in when we say, well, what about next quarter, next year? What should this company be worth on their basis of new profits. And there we need to make our own estimates, our own analysis, weighing in on how this company will perform in an unknown environment looking forward. So, excellent question. This definitely does fall in under subjective. So, thank you for asking. And that's why, in the end, analysts publish their opinions.
One thing I want to add to that is quality of management isn't just who the CEO is. I know a lot of investors get focused on the CEO, and a great example was when Steve Jobs passed away. Many investors said the idea man's left the house and didn't know if Tim Cook could do as good of a job. Quality management also goes to the board of directors. Is the board of directors comprised solely of people that used to work for the company that might be set in their ways of doing things and might be only elected once every 3 years? Or is the board of directors also comprised of people from other companies, both inside the industry and outside the industry, that might bring a fresh way of doing things? Maybe it's an oil and gas company, and you have somebody coming in from banking that might provide a good insight to how finance might impact things, or from a software company talking about new forms of software to help exploration and research that might help keep the company fresh so they don't wind up becoming stale. And a good example of a company that kind of became stale and is no longer there is, think about Blockbuster. Blockbuster didn't revolutionize with the times, and now there's only one brick and mortar location, and nobody really goes to Blockbuster anymore compared to some of those other well-known media names that maybe you might stream your content from. And so it's important to have that diversified board as well. And that's how it applies to quality of management, not just the CEO.
Great. Thanks for that, Nick and Jake. With that, we are pushing up at time here. Before we wrap up, just have a couple of final things to mention here to our audience. We do appreciate you joining us here. After today's webinar, you will get a thank you email here. Please take a look at that. We do have a number of links and resources in there to help you continue your education on this topic. I definitely want to encourage you as well to check out some of the other classes and coaching sessions offered by the Trading Strategy Desk. We mentioned that link to sign up for the follow-up question and answer session tomorrow. Always a great place to continue the conversation, or head to fidelity.com/coaching to find more from them here as well. We did record today's webinar here as well. So just by signing up for it, once that replay is available, you will receive an email from us with the link to that recording. But with that, we will close it up from here. Again, want to thank everybody for joining us. Thank you again, Jacob and Nick, and we'll look forward to seeing everyone at the next one.